Hey everyone, and welcome to today's DeFi Drop featuring Shiv Kapoor, Head of Engineering at Royco, whose latest product, Dawn, launched just last month. Royco is bringing risk tranching to DeFi for the first time in a meaningful way, with over 155,000 users, 10 million in TVL across 6 live markets, and a product that's been described as bringing TradFi's waterfall credit structure fully on chain. This is a conversation that feels very timely indeed. So welcome, Shiv. It's great to have you.
Thank you, Ed. Thank you for the warm intro. It's great to be here.
Cool. Well, let's get stuck in, Shiv. Royco started out as something quite different, a liquidity coordination marketplace and order book for incentives, which famously powered by the Royco campaign that bootstrapped billions in TVL for Bearer Chain. That was a very different product from Dawn. Walk us through the evolution. How did you go from an incentive marketplace to building a risk tranching protocol?
Yeah, so I think when you're doing a startup, it's always about capturing the present opportunity, right? And obviously with a longer term vision to grow. But at that point in time, incentives were extremely common in DeFi as kind of the core to bootstrapping liquidity in any product or protocol. Right. So we were really trying to capitalize on that by creating this central marketplace for liquidity in DeFi, where incentive providers and liquidity providers could come and meet and negotiate on incentive contracts to provide liquidity to the protocol for a given period of time. Right. And we were hoping through that entire marketplace that we created that incentive distribution and liquidity mining for both liquidity providers and incentive providers could be a lot more efficient. Right. And the pricing could be a lot better. And I think we achieved that to some degree, via Royco, as you mentioned, and their $3 billion liquidity acquisition campaign. And we also help power certain initiatives like the Aave Go stablecoin. But at the end of the day, I think we came to the realization, and it was a tough one, that incentives are not a long-term way of creating sticky users and sticky capital, right? At the end of the day, these incentives were vaporware. Hate to admit it, but that's exactly what they were. And we weren't actually creating the plumbing for the new financial system. So, we reflected on that and learned a lot from our time building that. And now we have pivoted to building this perpetual risk tranching product, right? Which actually deals with native yield now and structuring it in a way that is more compelling for both sides of the market and basically broadening any sort of tokenized asset or investment product, right, into having two distinct risk reward profiles. So theoretically, you should be able to get more capital in the door. So the asset issuer is happy, the investors are happy because now they have more optionality. And yeah, that's kind of the evolution where we're at right now. Exciting time.
Nice. Let's stick on the risk tranching, I guess, a bit. But risk tranching is a concept that TradFi has used for decades. CDOs, mortgage-backed securities, structured credit, etc. It's also a concept with slightly uncomfortable reputation after 2008. For a DeFi listener, can you explain maybe in plain terms what Dawn does in detail? I know you touched it a little bit, but let's go into it a bit. The senior tranche, junior tranche, a bit deeper, the waterfall mechanic, and crucially, what makes the difference, or let's say makes it different from the structured products that blew up in the GFC.
Yeah, totally. So at a high level, what Royco Don does is basically take any sort of tokenized asset that is priceable and tranches it into two separate tranches with two distinct risk reward profiles, right? So we call the protected and more risk off version of the asset the senior tranche, and then the more levered up and risk on version of the asset, the junior tranche, right? So you have these two complementary tranches, which are both being deployed. I mean, they're just pools of capital. They're both being deployed into the exact same asset, right? But they have obligations to one another, which transforms the risk profile of the asset itself fundamentally, right? So that's what it does at a high level. There are a lot of mechanism nitty gritties that we can get into if you would like, and I'm sure we'll get into later on in this call. But that's what we do at a high level in terms of how it's different than whatever happened in the great financial crisis and that entire blow up. I think GFC was actually the fault of the rating agencies, right? And the agencies that were responsible for actually labeling the rating of any given asset or structured asset, right? And I think they just packaged up a lot of subprime bullshit into stuff that they were calling prime, right? And that misled a lot of investors. Um, and that's not the case with on-chain products, right? So like you can see our coverages and you can see, at least for our purely on-chain assets that we're tranching, for example, we can go and tranche a Morphovault, right? And you can see the entire Morphovault balance sheet in real time on-chain on a block by block basis, right? So you can underwrite it on a block by block basis, right? So obviously this is kind of different for the tokenized assets that are coming on-chain, right? Their balance sheets might be more opaque, more TradFi-esque, right? Just because the actual underwriting and origination is happening off chain. But even for those assets, right? Like for example, we tranched Apex's APYUSD as our inaugural public launch market, and they're basically a stretch and SATA-backed stablecoin, right? And they have this accountable dashboard, which basically provides a real-time proof of reserves, right? So you can go and see, okay, like these guys hold, this percentage of their balance sheet in Stretch, this percent in T-bills, this percent in SATA, so on and so forth. And you can constantly underwrite based on the ever-changing nature of the balance sheet. So I think the transparency component of it definitely makes it different than assets and loan books that were involved back in GFC. But one step at a time.
Yeah. Transparency is key, right? That's why we're in this. So that's live functioning. Can you walk us through how that rate model actually works then? You touched a bit, but and be specific about what happens maybe when junior utilization hits like 100%.
Yeah.
Yeah.
So
What's the stress scenario, for example?
yeah. So I think let me kind of describe the entire mechanism from more of a technical point of view, right? And kind of the design trade-offs that we made when we actually designed the protocol, right? So first and foremost, right, we have these two tranches, and to put it simply, the junior tranche has a first loss coverage obligation to the senior tranche, and the senior tranche pays the junior tranche a risk premium, right? In order for providing that service of serving as first loss capital, right? So those are the two obligations at play. And what we really try to do in this product is take the best features of DeFi and TradFi and consolidate it into a single product that we call Royco Dawn, right? So the way that we really did that is that the actual tranches themselves are fully liquid and composable, right? So you have the liquidity and composability profile of any sort of DeFi asset that you're used to working with. For example, a Morpho market or Athena's SUSDS, right? Where you can go and like procure credit on your asset whenever you want to in a very composable and atomic fashion. But you can also deposit and withdraw from a Morpho market, and you can do the exact same thing with our tranches in what we call the perpetual state, right? So in the perpetual state, everything works exactly like DeFi assets work today, right? And that's wonderful. But then we started to think, and it's like, okay, well, this is fundamentally different than any product that we've seen in DeFi before, right? It's a structured product, and this is very new in DeFi, and there's no real playbook to follow here in terms of like what works and what doesn't. But thinking from first principles, what we came to is that, okay, well, if you're a senior trancher, right, you just want your coverage, right? You don't want to take losses, right? Um, and you want some minimum amount of coverage that's guaranteed at all times, right? And we provide both of those for our senior tranchers, right? But on the junior tranche side of things, you're providing first loss capital, right? And there could be like little wicks going on here and there and like volatility. I think Stretch is a great example, right? If you have an asset that is backed by Stretch, right? Stretch is meant to trade at a par value of $100 per share, right? And there are dividends that get paid monthly. I know there are talks about making it bi-monthly, but monthly as of right now. And the way that it basically works is that, okay, there's no like redemption liquidity for Stretch, right? If you want to get out or get in, you have to buy and sell it on secondary markets, right? So the value of the Stretch shares actually trade in between this like band. They oscillate, right? So it's like right after a dividend payment, right? The price falls a little bit to basically account for the time until the next dividend payment, right? Because like no one, like there is opportunity cost to holding that, right? So people start selling off, and then as that time or that gap between now and the next dividend payment um, encroaches in, right, people start to buy back, right? And right before the next dividend payment, the stretch shares actually trade at a premium, right? So there is this like inherent volatility that happens or is supposed to happen. It's expected, right? But if we had made our senior and junior tranches liquid at all times and went to go tranche a product like Stretch or someone that held Stretch on their balance sheet, right? Then there would be this volatility that juniors would have to underwrite constantly, right?
Mm.
So if seniors could withdraw at all times, let's say let's just like play the extreme scenario, right? Where okay, the dividend gets paid, right? And you have this junior tranche and the senior tranche. Stretch price routinely, as it's meant to, drops a little bit, right? And the senior tranche, or rather the net asset value of the asset of the book sees a small loss, right? At that point, if both tranches were fully liquid, right, the entire senior tranche could just withdraw, forcing the junior tranche to go and realize that coverage capital that they promised, right, and book losses themselves, right?
But
That's not
there's
an
no grace window.
exactly, right?
Right.
So what I'm trying to get at is that look, guys, we really do have some amazing features in DeFi, right? Namely liquidity and composability, right? So we kept those when they made sense, right? But in a scenario like this, it doesn't really make much sense, right? To allow the junior tranche to realize losses at all times, right? So we basically have this inbuilt observation period, okay? And this basically is analogous to a fixed term. Okay. So when the asset is going up and yields are going up and you know risk premiums being paid and seniors are happy, everyone's happy, right? Then we're in a perpetual state, right? But as soon as there is any sort of like minor routine drawdown, right? And emphasis on minor, right? If there is something that like really does drain the coverage capital in the system, right? Then seniors can realize that coverage. But if there's a minor routine expected drawdown or volatility, right? We enter this fixed term regime, right? To mirror TradFi and their principles because they nailed it. It's like you shouldn't be underwriting this stuff on a second by second basis as someone that's providing first loss capital, right? And we enter this fixed term regime that goes on for a pre-configured period of time. And at the end of that, seniors can withdraw, right? New
Mm.
juniors can come in, diluting existing juniors, right? Or if the asset just naturally goes and recovers during that period, right? Everything's good and healthy, and we're back in a perpetual state.
That observation period is doing a lot of structural work, right? It's essentially the difference between like mark to market panic and actual realized loss, which brings me to the yield side of this, because the system isn't static while that observation window is running. The split between senior and junior yield isn't fixed. I guess it moves with utilization in a way that deliberately like it's reminiscent of how Aave or Morpho price the cost of borrowing.
Yep.
Right now in the
Yep.
USD market, you've got senior, I think, sitting around 8.3%. Junior north of 40 or something,
Yeah. At
which is
some point
nuts.
last week, yeah, it was pretty crazy. I think, yeah, what a
Yeah.
week.
Yeah. And then utilization at like 96%, junior capital leverage. What was it? Like roughly 6.4 times or something. But yeah, walk me through that equilibrium and walk me through how it
Yeah,
works, I
totally.
guess. Specifically what happens. Yeah. Senior
Yep.
depositors, juniors, all of that. Go for it.
Yep. So from first principles, right? It's like as a senior trancher, right? What am I? Who am I as a person, right? I'm a risk off LP that has a pretty low opportunity cost of capital, right? I'm sitting there and I want some like stable returns, right? But at the end of the day, I just want a guaranteed first loss buffer, right? Like I'm underwriting this asset and saying that okay, it can draw down X%, and I want to be protected against that, and I'm willing to go and pay for it. Right. That's who I am as a senior trancher. So if we go based on that presupposition and um, then go ahead and derive, okay, well, we need X% of first loss drawdown coverage, right? There at all times. But at the same time, as if you look at this from the junior trancher's point of view, right, they don't want to be locked up. right? They want to be liquid as well, right? They want to be able to come in and out, right? So it's like, okay, well, if we assume both of those things, right, then the exact point of X% first loss capital in the system is not what you should be optimizing for, right? Because that is invariant. Without any losses, our system has to go and guarantee X% first loss protection, right? So what we're actually optimizing for is a slight surplus, okay, of junior capital in the system at all times. Um, and as that surplus starts to fall slightly, we start to incentive or push more of the yield towards the junior tranches to attract more to come in to bring us back to that like equilibrium point where there is a surplus, there is a 10% buffer of capital where juniors can withdraw, juniors can leave if they want to opt out, but seniors are still fully protected, at least by the minimum coverage percentage that they were promised. So so we have this entire adaptive like rate mechanism where it's like, okay, based on the supply and demand of both tranches at any given point in time, the risk premium that's paid by the seniors to juniors adjusts itself on a second by second basis in order to make sure that the market lands at that equilibrium point.
Yeah, that equilibrium mechanic, the system like constantly nudging yield to keep the buffer healthy. It's essentially live risk pricing, which is great. But
Yep.
let's get some current affairs going. What you've just said basically makes what happened on the 18th of April like the most instructive case study, I guess you could ask for. Like last month, the restake teeth exploit that hit like what 196 million or something in bad debt spread across depositors. They had zero exposure to attackers' position, all that stuff. We all know what happened. But Dawn is supposed to prevent exactly that. How did you watch that unfold? And like more to the point, have actual institutional risk committees written tranching into their mandates as a result? Or is the interest still at the conversation stage?
Yeah, so I want to make it very clear that Dawn obviously is meant to protect against losses, right? But our unique value proposition is not to go and protect against like hacks and exploits and tail risk events, right? We believe that like LPs at the end of the day, and it's pretty unfortunate, but LPs at the end of the day should only have to underwrite economic and financial risk, right? They should not have to go and underwrite smart contract risk, one of one DVN setup risk, like any of that stuff, you know? It was very unfortunate that happened, and this is the state of the industry that we operate in. But at the end of the day, Dawn is not meant to go and protect folks against these like tail risk events. Like that's not what's being priced in, because if you were to go and price that in, it's binary, right? So it would probably cost everything to the senior tranche to go and actually get coverage for a tail risk event like that. And then the yields just wouldn't make sense whatsoever, right? So that's one thing. Secondly, and this is tangential, but with everything that happened with Aave and even the Resolve incident that happened about a month, 2 months ago, right? We saw extreme credit tightening, right? From that point, it's like everyone started to withdraw because there was like contagion risk where like one asset that's being lent to affects other markets that are also being lent to by the exact same curator, right? So it's kind of like a race. It's a bank run scenario where people race to the exits and basically try to pull all the cash off the table while they can, right? So that's what we saw happen, right? The beauty of our junior tranches, though, right, is the fact that like anyone that was actually borrowing and saw rates spike due to that credit tightening that happened in the broader lending and money market ecosystem, right? They had to go and sit on negative NIM, net interest margin, for an extended period of time, wiping away a lot of their gains, probably, right? And potentially even causing liquidations, right? Which is very unideal because it's like, okay, you were underwriting. For example, if I'm looping SUSDE, right? Um, and some other asset that's being lent to by the same curator, right, gets bricked or hacked, or there's some like tail risk event that happens, and credit tightens in that vault, and now my rates shoot up because of that, right? I didn't underwrite this going on. What I was underwriting is SUSD the asset, and I want levered exposure on SUSDE and its yields. So, that you can call that a flaw in pool-based variable rate lending, right? But really, it's as simple as taking the asset and structuring it into a senior and a junior tranche, right? Like you can view lenders as the senior tranche and borrowers as the junior tranche, right? So in the case of our tranches, if we were to go and tranche out something like an SUSDE, right, there is no risk of negative NIM, right? All you're underwriting is the economic appreciation and depreciation of SUSDE itself, not any sort of rate spiking or credit tightening or any sort of macro event, right? Other than what Athena's balance sheet might be exposed to. Does that make sense?
Yeah, it makes sense. I'll move on now to Strata Markets, I guess. No. Your first vault. What was your first vault again? It's Roy USDC.
Yes. Yes.
Curated by?
Dialectic.
That's correct. How does a curator relationship work? What mandate does Dialectic operate under, and what's the governance model,
Yep.
etc.?
Totally. Yeah. In terms of our relationship with Dialectic, Jay, our co-founder, he he had a relationship with them prior to this vault kicking off, right? And we were in conversations with quite a few curators about managing this vault that we're running now. And Dialectic just stood out, like they're super competent, super experienced. They have over 6 years of experience in on-chain asset management with a pretty exceptional track record. And we spoke with their team, and we all kind of got to know each other, and it was kind of a no-brainer at that point in time to go with them. So very, very grateful that we made that decision. In terms of their mandate, right? We're running a senior USDC strategy, which basically means that they're going to be allocating into senior tranches across the Royco ecosystem, right? Which they go and underwrite. This does not mean that they're going to be allocating to every single senior tranche that we go and deploy, but rather they're going to do their own underwriting and due diligence on all of these assets and decide whether or not it makes sense for them to go and deploy capital into it, right? So that's the mandate as of right now, right? But that mandate is subject to change, and it might be changing very soon.
Sorry, guys, I had a bit of a technical glitch with my mic, but we're back. So thanks, Shiv. That was great. Quickly moving on. Strata Markets launched before you guys as a direct competitor. Same tranching concept. The tranching narrative is clearly gaining momentum. We're seeing a lot of this, especially through Stephen DeFi Dojo and other prominent voices. But what does Royco do that Strata doesn't?
Yeah, so I think fundamentally we do two things differently, right? First and foremost, we guarantee a minimum coverage for our seniors at all times, right? We kind of talked about previously how that's at odds with keeping the junior tranche liquid, right? But we have this adaptive risk premium model to ensure the junior tranche also stays liquid, and there is a slight excess in that first loss capital buffer to ensure that, right? So that's the first thing. But secondly, and I think more importantly, is that we have a fixed term regime, right? The observation period that we talked about, where if you have these assets, right, which might see minor wicks and volatility, and let's be honest, a lot of them do, right? Like even a pretty diverse loan book can go and see one default here and there, right? Like that's completely understandable. We don't live in a perfect world. So in our case, we enter this fixed term regime, right, where the juniors are protected during that time and they're not constantly and eternally underwriting ongoing volatility, right? And minor wicks and drawdowns that can happen either routinely or just here and there that don't really have a material impact on the actual coverage that's being provided, right? Isn't a substantial enough loss event where seniors are really at danger, right? But also not substantial enough for the juniors to go and realize losses immediately. So I think those two things make us different than Strata. But you know what? Like they found some PMF. They're doing pretty well. I'm happy for them, and yeah, best of luck to them.
Yeah, it's great. Also, competition's a great thing.
Totally,
It's a
totally.
great
No, I
thing.
think it brings out the best in us, and it's definitely exciting for everyone to watch and experience too.
Yeah. Well, look, I'll start narrowing into the finish line here, but on the way there, let's just cover these last few points. But there are two very different user types here. Okay, well, not very different, but well, yes, very different, but two different user types: the retail depositor, who wants protected USDC yield, and the institutional risk committee that can now quantify and verify the first loss buffer on chain. are you building primarily for one of those audiences, and is there a path where a conservative institution genuinely puts meaningful capital into SROI USDC today?
Yeah, I think definitely we're building for everyone, right? At the end of the day, like it's our point of structuring is to appeal to a broader base of investors, right? So we're building for everyone, no matter whether you're risk on or risk off, right? Right now, we have a managed product for our senior tranches, right? Curated by Dialectic, as we talked about. So that's kind of where we've started from the asset management side of things, right? But God knows someday we might and probably will have a junior vault, right, which takes your money and manages it into various different junior tranches. So yeah, I think this is like the very beginning. Obviously, as an investor, you also have full optionality and discretion over which tranches you want to be allocated into, and you can hand pick them if you'd like, or you can pick our managed offering that we have if you prefer ease of use and not really kind of like a set and forget sort of strategy where you just park your money and forget about it and have it be managed by someone that's a professional. But I don't think that any sort of DAOs or treasuries or foundations, right, should not consider allocating into either our vault or senior tranches, right? Like I think if you're going to deploy your asset somewhere on chain anyway, right, and your entire mandate is to be risk off, then a senior tranche is a strictly better version of the underlying asset for serving that purpose. So yeah, so if you're a risk off investor, you should definitely, go into the senior tranche. And then the thing is that even as we talked about with like negative carry and negative NIM, if you're a leveraged looper, right? Junior tranches are a strictly better way of expressing that. So if you want levered exposure, right, and you're underwriting a singular asset, you should not have to go and underwrite the volatility of rates, right? That's not fair. So yeah, junior tranches are definitely a better medium to go and take on and establish levered exposure as well. And then on top of that, just to add on, I think our senior tranches are actually the immaculate collateral, right? It's like if you're a curator that's going and lending to all of these different assets, right? And you do your DD on them and make sure that they meet your mandate. And after that point, if we go and tranche it out and we have a senior and a junior tranche, right? The senior tranche is a strictly better version of the underlying asset from a risk point of view. Like the senior tranches actually do just serve as better collateral as well, right? So if you're a senior trancher, you don't have to settle for the base rate of the senior tranche, right? You can actually go and loop the senior tranche itself, right? And start getting first loss protected levered exposure, which is an extremely novel concept in DeFi, right? And also, if you think about it from like a structuring point of view, it creates like a completely new mezzanine layer in the capital stack that didn't exist before, right? So you have junior, which is like our tranches junior, which is the equity capital, right? Then you have our senior, and if you're looping that, then you're technically junior to the lenders that are lending to you. So you're sitting at a mezzanine layer, right, where you are first loss protected, but you are levered up, right? And you do have some more exposure than the lenders above you. So it does create like another layer in the entire DeFi capital stack.
Yeah, it's a great structure you've got going on. I'd love to carry on. We can't. We're running out of time, and we try and keep these like short and concise. But thank you very much. It's been great chatting to you. We've covered a few important parts of the Royco machine, and yeah, I can't wait to see it develop over time. I think we're right now at a pretty exciting phase. It's been a bumpy ride the last couple of months, and I think we should be going upwards from here. I say that every time. Somehow we go down, but
Yeah,
no,
totally.
look, it does seem like a natural sort of clean out. But look, Shiv, we always end this with a bit of a fun question. It's a bit like, I don't know if you ever watched Top Gear, where they do the car, which the reasonably priced car, and they drive around the track and they have a leaderboard. But this is just like kind of like that. But we always have this question, and we change the date so that it's not, so that it's done in batches. But look, what's your prediction for the total TVL of DeFi as per DeFi Llama on the 21st of June? So that's only in about a month's time. 2026. So as reported by DeFi Llama. So yeah, it's currently 85 billion.
Yeah, I mean, if you gave me like a year, I think I might be able to like deduce something, logically. But this is like pretty arbitrary. I don't know what can happen in a month. Honestly, I don't think it changes too much.
Go with 85 billion.
Yeah, I mean maybe a bit
Yeah.
more because of
Okay.
like payment volume,
Yeah.
stablecoin payment volume. But I'm sure that there's going to be a lot of off ramping too, so it probably nets out.
All right. Cool.
But yeah, I think unchanged, static.
That's the first unchanged we've had
Really? Okay.
in a year.
Okay.
And we've had a couple of no, we've had one bearish scenario, but the rest have
Okay.
all been bullish scenarios, mostly proven wrong.
Yeah, I know, man. I know.
Anyway, but
But
thanks.
the entire, and if you don't mind me adding one more thing,
Yeah, go.
but I think the rates just don't make sense right now in DeFi, and as an industry, like this is the one problem that we should really go and solve. Like there's too much supply side, right, to go and deploy. And like I know that like tokenization and everything is one step in the right direction, right? But end game here is actually like purely on chain origination and like credit life cycles and everything going on chain from lending to actually deploying that capital. Um, or sorry, asset management to actually originating loans on chain to real businesses, right? Cash flows coming in on chain and then repayments also happening on chain, right? Like that's end game. That's really how we take this to where we want it to be. But I think tokenization is where we go in the short term, right? And structuring that is actually just going to help multiply the TVL that can be absorbed into even those new assets that come on chain.
For real. Agreed. Agreed. And that's what we're seeing. We're starting to see that already. So I
Yep.
think it will continue. Look, Shiv, thank you so much. I really appreciate you jumping on. I know you're seriously busy, you guys, working around the clock. So appreciate your time. It's been great. Thank you very much.
Thank you, Ed. Thanks for having me. Have a good day.
Cool, man. Thank you.